Inflation is often described as a tax that nobody voted for. It is the gradual, relentless erosion of purchasing power, the process by which the same dollar buys less over time. Most people experience inflation through rising prices at the grocery store or the gas pump, but the deeper effect is less visible and more insidious. Cash sitting idle, in a checking account, under a mattress, in a safe, is slowly losing value every single year, even when nothing dramatic is happening in the economy. Understanding inflation is not just academic. It is directly relevant to every financial decision you make, because ignoring it means you are almost certainly losing money while thinking you are doing nothing wrong. The United States has experienced an average inflation rate of roughly 3% per year over the long run, though it varies substantially by period. The inflation spike of 2021 and 2022 reminded many people of what high inflation actually feels like. But even at a relatively modest 3% annually, the cumulative effect over decades is dramatic. $100 in 1990 had the purchasing power of roughly $225 in 2024. Conversely, $100 today will have the purchasing power of about $45 in 30 years if inflation averages 3%. That means cash held flat over 30 years loses more than half its real value. This is not a catastrophe. It is just math, but it is math you need to account for in how you hold your savings. The Federal Reserve targets an inflation rate of 2% as the official policy goal, considered low enough to be manageable but high enough to avoid deflation, which has its own severe economic problems. The Fed manages inflation primarily through interest rates, raising rates to slow borrowing and spending when inflation is too high, and lowering rates to stimulate the economy when it is too slow. When the Fed raises rates dramatically, as it did in 2022 and 2023 in response to the post-pandemic inflation surge, borrowing becomes more expensive for consumers and businesses, which tends to slow down economic activity and bring inflation back toward target. This cycle repeats throughout economic history. The most important practical implication of inflation for personal finance is this: keeping money in a low-yield savings account or a standard checking account effectively guarantees a real loss. If your savings account pays 0.5% per year and inflation is 3%, you are losing 2.5% of purchasing power annually. This is why financial advisors consistently recommend that money you will not need for 5 or more years should be invested in assets that have historically outpaced inflation, most commonly, diversified equity index funds. The S&P 500 has averaged roughly 10% per year before inflation and around 7% after inflation over the long run. That real return, compounded over decades, is how inflation is defeated. There are several categories of investments that have historically performed well as inflation hedges. Treasury inflation-protected securities, known as TIPS, are government bonds whose principal adjusts with inflation, guaranteeing a real return above inflation. Real estate has historically kept pace with inflation over time, since property values and rents tend to rise with prices. Commodities, including gold, oil, and agricultural products, often rise during inflationary periods. And the broadest equity index funds, while volatile in the short term, are the most reliably inflation-beating asset class over long time periods, because companies can raise prices along with inflation, which eventually flows through to earnings and stock prices. The takeaway is not that you need to become an inflation expert or to constantly monitor CPI reports. The takeaway is to understand one fundamental principle. Cash loses value over time, and money held too conservatively for too long guarantees a real loss in purchasing power. Build your emergency fund in a high-yield savings account that at least partially offsets inflation. Invest money you will not need for 5 or more years in diversified equity index funds. And do not let fear of market volatility drive you into the false safety of cash, which is guaranteed to lose purchasing power while appearing perfectly stable. Inflation is silent, but its math is relentless.